Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the Chief Strategy Officer here at OptionsPlay. And today we're here to talk about a topic that is virtually useful for just about every single investor. Even if you're not an options trader, even if you're still just getting started with options or just learning, this is a strategy that really is for anyone who is an investor in the broader market. So if you own any stocks or ETFs, this is a strategy that you can use to generate income on your portfolio. It does utilize options in order to generate that income, but I think you should really think about this more so from an investing strategy rather than an options strategy. So let's go ahead and get started. But before I do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we're going to discuss during today's session. So what we are going to cover today is a covered call. Now, before we continue on, how many of you currently have stock or ETF holdings in your portfolio? Please type 1 into the chat window if you currently have stock or ETF holdings in your portfolio. Okay, I see a ton of ones because everyone that answered 1, this is really a session for you, because if you own stocks or ETFs, this is something that you can do to generate additional income in your portfolio. You might be surprised how much income you can potentially generate. And also, if you consider the current market environment, having some downside protection / income would probably go a long way in the current market environment that we are in. So in order to help you better understand cover calls, we're going to go through a real example and go through what are considered optimal cover calls. Really important to understand, out of all the universe or all of the potential options that you have, how do you select the optimal cover call? Then I want to show you some of the income reports that we have that help you automate this particular step. And then lastly, we'll talk about trade management. We'll try to go through some live examples based on some holdings that you might have in your portfolio and try to use them as examples before we open this up for Q&A. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can you generate additional yield on a portfolio using covered calls. So let's first frame this discussion as to who this session is for. Like I said in the beginning, this is a session that's for everyone that has a stock or ETF holding in your portfolio. And if you look at the constitution of most investors, now this doesn't necessarily mean this is exactly what your portfolio looks like, but when we look at portfolios across the broad spectrum, we tend to find that about 80% of most investors' wealth are tied in equities and long-term investments. So those stocks and ETFs that we were referring to, this could be in your retirement account, this could be in your brokerage account, this could be in a variety of different accounts. And then we also obviously have, many of us have kind of speculative accounts, but generally speaking, we tend to find that the active trading, the speculation part of most portfolios, generally speaking, accounts for a relatively small percentage of most investors' wealth. The most of your wealth is tied into these long-term investments. And this is really what we're here to talk about here today, are these long-term investments that you hold, these assets that you hold. How can you utilize those assets to generate income? Because many times these are assets that kind of sits away. You don't really look at them every single day per se, but they are potential assets to help you generate income. And that's really what we're here to talk about. So what you're going to find is that based on the examples today, we're going to show you how you can sometimes generate 1 to 2% monthly, 1 to 2% yield on these assets, the 80% that you hold in long-term investments, how you can generate about 1% many times a month in income using these few and simple rules that we're going to discuss here today to achieve consistent income stream. Okay. Now, how many of you have traded a cover call in your portfolio before? Please type 2 into the chat window if you have traded a cover call or sold a cover call in your portfolio before, and type no if you've never sold a cover call before. I just want to get a sense for the audience here in the room. Okay, I see mostly 2s. I see some no's, or quite a few no's now. So for those of you that have experience trading cover calls or have done it before, hopefully today will give you a better understanding as to how to go about doing it in a consistent way. I think a lot of investors who have sold cover calls but maybe aren't doing them today usually stop because of one particular reason, which is typically they sold their stock too early and they feel that they lost out on opportunity because of the cover calls they sold. And we're going to talk about some of the ways that you can mitigate that, and just how do you go about selecting the right cover calls to sell. And for those of you that said no, hopefully you learn something and take away a reason as to why options may belong as part of your long-term investment portfolio, which we typically don't think of as an options focus for our portfolio. We usually think of those as stocks, ETFs, mutual funds. But today we're going to talk about how options fits into your long-term investment portfolio. So what is a cover call? A cover call is simply selling a call option. Now, when you sell a call option, you're going to collect premium, and that premium is the income part of this particular strategy. But when you sell a call option, you have unlimited risk to the upside. So if you sold the call option on a stock naked, meaning you just sold the call, if the stock was to rally substantially, the further it rallies, the more money you lose. It's the same position, very similar position as shorting the stock. When you short the stock, if the stock goes higher and higher and higher, you lose more and more money. So you have the exact same risk profile from selling a call option as you do from shorting the stock in terms of risk. Your reward is the premium that you collect from the call option. So a lot of investors will say, why would I ever want to sell a call option for limited reward and take on the unlimited risk if the stock keeps going higher and higher? And the answer is you don't want to do that. What you want to do is you want to sell a call option with stock that you own, because the stock position will effectively offset the unlimited risk factor of a short call. And that's why we call it a covered call. It's a call option that's covered by the stock that you own. And when you sell this call option, it obligates you to potentially sell your stock at the strike price that you sold the call option for. We're going to go through a real example to help you solidify this concept as to what you're actually doing. But it's important to remember that this is a strategy that requires at least 100 shares of an optionable stock or ETF. So you need at least 100 shares of an individual stock before you can sell a call option against it, because each call option represents 100 shares of the stock. So when you sell a call option, you're obligated to sell the stock at a specific price sometime in the future and deliver 100 shares of that stock. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. And if it doesn't make sense, hopefully when we go through the examples, this will make more sense to you. Okay, I see a lot of 3s. Perfect. So let's talk about an example. I'm going to use Enbridge as an example. Okay, so Enbridge is, energy stock here. Recently, having a bit of a pullback here, along with oil as well, but still one of the strongest stocks in the market. Perhaps you believe that oil will continue to remain strong. These names will continue to generate a fair amount of cash flow, as we've seen. So you want to be a long-term investor in an asset or a sector that continues to perform quite well. But in the short term, you're seeing some volatility and you want to be able to capture some income and perhaps even buy some downside protection during this volatility. So I'm going to use Enbridge as an example, currently trading around $54 or so. So let's say you own 100 shares of Enbridge at $54. And let's say you have a target price of $60. So you currently own 100 shares at 54. You think it's going to reach 60 and you want to sell your stock once it reaches that $60 target. So what we're going to look at today are what happens if you're an equity investor and what happens if you're an options investor, and compare the two. So as a stock investor, and for those of you that currently have stocks or ETFs, you've all have done exactly this, which is place a limit order at the price that you want to sell the stock at. So if you think that you have a target price of $60, you can place a limit order to sell your stock at $60. How many of you have done this for stocks that you own? Please type 4 into the chat window if you've ever put in a limit order to sell your stock at a higher price. And I expect pretty much everyone who's answered that they own stocks or ETFs would answer a 4. Okay, so this is on the left-hand side, you're all familiar with that. And what we're going to do today is compare that to selling a $60 call option, which, if you think about a limit order, when you place a limit order at $60, what does that obligate you to do? It obligates you to sell 100 shares of your stock at $60 when you place that limit order. Now, what happens if you sell a $60 call option that expires in September? You have the exact same obligation to sell that stock at $60. Now, it's not apples for apples. A limit order gets triggered immediately once the stock reaches that $60 price. a cover call or a call option that you've sold only obligates you typically near or at the expiration date if the stock is above that $60 price. So what you could potentially do is see the stock reach 60, and then maybe a few days later it comes back down. But by the time you reach September, the stock is still below 60. In this particular case, your order is not filled, if you will, meaning you still actually end up owning the stock, versus your limit order would have been filled the second the stock reaches your target price or your limit order, and it would have been filled. So there is a distinct difference between the two, but the obligations are the same. The difference is that by placing a limit order, there's no economic or material gain there, right? The limit order just simply obligates you, and it sits there until the obligation is satisfied, either because it's filled or you've canceled the order. But when you sell a call option, you get the exact same obligation, but you're getting paid. Whatever the call option is currently priced at, you get paid that amount of money in order to sell that call option or take on the obligation. So what happens if you are a stock investor? Because you bought the stock at $54, that's your risk, $54 a share. Your potential reward is the difference between your target price and the price that you purchase it. So you're risking $54 to potentially make $6. And you have exposure in the stock until the stock reaches the $60. Not only do you have exposure, but you also collect the dividends while you maintain that exposure. So as long as you have exposure, you're exposed to the stock moving higher or lower. So as an options investor, what happens is that, first of all, my risk is actually decreased by the premium that I collect. So if I collect 50 cents, immediately the risk that I take on my stock, which was $54, is now reduced to $53.50. And what it does at the same time is it increases my potential reward from $6 to $6.50. Doesn't sound like a whole lot, but we'll see in terms of percentages what this comes out to be. And we'll also take a look at, from the perspective of yield, what that looks like. And think about it not only from a single cover call, but you might sell multiple cover calls before the stock actually reaches your target price. But the goal here is that you want to generate not only the dividends, but also an additional 50 cents for every single earnings, or every single cover call cycle until the stock reaches your $60 limit order. Okay, so what you're doing is you're just adding additional income while you wait for the stock to reach your target price. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Perfect. So let's do a little bit of a thought experiment. Now that we understand the strategy conceptually, I want to look at some actual numbers, because this is really arguably the most important slide. If you learn nothing else from today's session, hopefully you take something away from this particular slide, okay? Enbridge currently trading at 54. Now, when you pull up an options chain, when you are looking to sell your cover call, you have hundreds of choices. You have quite a few different expiration dates, and across each expiration date, many times you might have a few hundred strike prices to choose from. And this is really kind of the overwhelming part when it comes to cover calls. If any of you have felt overwhelmed when trying to pick the right cover call, please type yes into the chat window. I know I'm going to get a lot of yeses here because it is confusing. There's just too many choices. So what I want to do today is help you understand how to make the right choice from a outcome-based perspective, meaning if you consistently sell cover calls in your portfolio on as many stocks as you possibly can, how do you pick strikes and expiration dates that maximize the income while at the same time maximizing your outcome for the strategy itself? Because you have to think about it as two components. It's not just the income, but also the stock that you own. So in this particular case, I'm going to do half the work for you. I'm going to say that we've already done all the back testing on the expiration dates. We tend to find that in Canada, the optimal expiration date is going out about 60 days. We tend to find that you need to go a little further out in Canada because volatility is a little lower in Canada. Trading costs are a little higher. So you tend to have to go a little higher premium in order to overcome your higher transaction costs that you have in Canada. So we've done that work for you in terms of selecting an expiration date. So I've done half the work for you. Now let's take a look at the strike prices. So the stock's currently trading at just a bit above $54. So let's say the stock, we have three different strike prices: 56, 58, and 60. Right. So I've drawn these three lines. This is how far the stock has to rally in the next 60 days before the stock is called away. So if the stock rallies substantially, these three strike prices represent the price at which you have to sell your stock. Now, if you sold the $56 call option, you'll collect $1.15 in income. If you sold the 58, you'll collect 65 cents. If you select the $60 strike price, you collect 50 cents. And what you have here are the static returns here on the right-hand side. So 0.9%, 1.1%, and 2.1%. That's how much you are collecting in the next 60 days. And just to put that into comparison, this stock earns 6% a year in dividends. Here, you're earning annualized 5% from the $60 call option, 6% from the $58 call option, and 11% for the $56 call option. So one question that I have for you is, if you had to choose a cover call, which strike price would you choose? Put your answer into the chat window: the 56, the 58, or the 60. I've given you the information there. Which one would you choose in terms of your strike price for selling cover calls? So my guess is that quite a few people have probably seen some of my education, because I see a lot of people answering what I believe is the correct answer, but I also see a lot of 58s and I see quite a few 56s. So a lot of 60s, quite a few 58s, and a lot of 56s, right? And I think that, as far as why someone would select 56 is pretty obvious, right? Because these annualized returns look quite strong, and especially when you compare these annualized returns to the dividend yield. You're effectively almost doubling the dividend yield. So you're effectively tripling your yield on a cover call like this. And then on something like this, you're just barely getting as much as the dividend yield. However, this is something that we've backtested over and over again, over about 20 years of data, and looking at the outcome, not only of the cover call, but also the underlying stock that you own. Because you have to remember, you own that stock because you think that stock's going to go higher. You have to consider that in your inputs when you're thinking about your cover call. So when we do this backtesting, it is very clear to us, there's no gray area as to which strike price is best. And it's the strike price that actually collects the least amount of yield, which sounds very counterintuitive for an income generating strategy. You would think that in order to maximize income, you would want to select strike prices that have the highest returns. But the data does not show that. The data shows that the lower yielding, higher strike prices that collect a smaller amount of income are going to give you the best outcome in the long run. And it's important, and it's a great question as to how is that possible. And the thing what you have to think about here is that the difference between this premium and this premium in this particular case is 65 cents. So the difference between 50 cents and $1.15 is an extra 65 cents in premium. But what are you getting for that extra 65 cents? That's really the question. And the answer is that if you sold a $56 call option and the stock rallies substantially, you're selling your stock at 56. What you're giving up is all of this upside. So what you're giving up, just to be clear, is that you're giving up, in this particular case, $4 in stock upside, which is the equivalent of $400 per share, in exchange for 65 cents or $65. So what you're saying is that I'd rather take $65 today, and I'm willing to give up $400 in the future. And if you keep doing this equation over and over again, in the short run, you'll keep getting an extra 65 cents for a few months. But the 1 month the stock rallies substantially, you give up $400. That's when your outcome becomes worse for you in the long run. And that's why when you're selling covered calls, you generally want to use about a 15 delta. 15 delta represents a strike price that has only a 15% chance the stock is going to be above that price at expiration. So what happens is that 85% of the time, you're going to collect 50 cents. And that one out of roughly 6 trades, or 6 cycles, if you will, when you're selling cover calls, and that stock just makes that big rip to the upside, you're going to capture most of that. and you're going to capture 50 cents every single 2 months or so, in this particular case, every 60 days, which is going to basically double your dividend yield, and you're going to capture, when the stock makes a big move. So that's why when you're selling cover calls, don't let the higher yielding, returns entice you into giving away too much of your upside in exchange for an extra 50, 60 cents in the short run. Does that make sense, everyone? Please type 7 into the chat window if that makes sense to you. And like I said, if you learn nothing else from today's session, arguably this is the most important piece of research that we've done here at OptionsPlay that helps you find a consistent income stream in your cover calls and avoids when the stock makes a big move that you do not participate in that. Most of the time I hear from investors that tell me, oh, I used to sell cover calls, I stopped doing it because usually it's because the stock that they own that they thought was going to go higher 1 month did go higher substantially, and they did not participate in it at all, because what they were doing is they were saying, I'd rather have an extra 50, 60 bucks in premium up front because that sounds great. And then I gave up $400 on the back end of that. And that's when I see a lot of people say, this is not the strategy for me. I'm not going to keep doing this because I've given away my upside. Well, don't give away your upside. There's still income to be had without really giving away too much upside. And this way, when the stock does make a big move, you capture that, okay? So more important than anything else. Now, here's the thing, is that doing this work yourself of selecting the 60-day expiration and finding the 15 deltas, if you are fairly proficient with options, is not difficult, but it's still work that you have to do every single time. So what we've done is we've automated this for investors. We have a report that gives you a list of all TSS optionable stocks. And what we've done is we've found the expiration date and strike price that makes sense based on that 60-day 15 delta cover call. And what you have is the symbol, the expiration date, the strike price, everything that you need in order to make that decision. So we have every single TSX listed stocks that's optionable available on this report, and this is updated every single day. So when you log into your, it's updated at around 10 a.m. every single day. So when you log in the mornings and you're thinking about selling a cover call, especially after Friday afternoons, on Monday mornings after your previous cover call has just expired, come back to this report, because for any stock that you go down the list for, let's say you own Tilray and you own this particular stock, this is telling you to look at the August 5.25 strike price premium, 5.25 strike price. That's going to collect you about 19 cents in premium for every 100 shares, or $19 for every 100 shares. That's going to generate 4.65% in the next roughly 37 days. So if you annualize that out, that's 56% yield. And this distance to strike is 28%. The stock has to rally 28% in the next 37 days before your stock is called away. And if it, let's say, rallies 40%, you're going to capture 28% of that move in the stock. And if it doesn't, you're going to annualize in terms of yield 56% in terms of income. In this current volatile market, you're going to find a lot of these higher yielding opportunities. The more volatile the market is, the more premium you're going to collect on these call options. Now, Tilray may not be a best example of a widely held stock. I know many of you have marijuana stocks, but maybe many of you have sold them off over the years because they've really underperformed. So you effectively go down the list and look for stocks that you own in your portfolio. Let's say you own Shopify, especially after the stock split, trading at much more reasonable $40. So this is telling you to look at the August $52 call option, which collects 2.89%. And you can click on the trade here on the right-hand side, and it'll bring up this trade here in OptionsPlay. And this will allow you to look at these trades and analyze them within OptionsPlay quickly for an opportunity. So I'm looking at Shopify. Selling this August $52 call option will generate 3.36% yield on a stock that pays 0 dividends. So if you own Shopify, you've been sitting through some of this underperformance and volatility. Well, now you can add 3% every single month to your income on a stock that you may be thinking that I might be holding on to it for a while because maybe you bought the stock when it was in the hundreds, $100 plus, and now it's trading at 40 and you're thinking I'm in for the long haul. Well, guess what? Then you might want to generate some income, and you want to do so in a way where it still captures as much upside as possible. The stock has to rally almost 28% in the next 37 days before the stock gets called away. So again, what we're trying to find are strike prices that are far away, that generate a fair amount of premium for you. And at the same time, if the stock does rally substantially, you are able to capture as much of it as possible, if not all of it. So that's really, what I wanted to show you here today in terms of, the strategy and the tools that we have built here at OptionsPlay that allow you to implement what we've learned here today. So lastly, let's talk a little bit about once you've sold the cover call, what do you do? So I've spent a lot of time talking about how to get into the trade. Let's talk a little bit about what do you do once you're in that cover call. So most of the time, I would say people are pretty happy with their cover calls in the, once you sold the cover call, three things can possibly happen. The stock moves substantially higher, the stops moves lower, sideways, and the stops move lower. So let's talk about if the stock moves substantially higher. And again, this is the scenario where I see a lot of investors sort of panic because the call that they've sold now has an unrealized loss. And if they hadn't sold that call option, they're thinking to myself, I would have made a nice fat profit on the stock, but now I'm capped in terms of how much profit I can make because I've sold this call. But this is really where, again, think about the fact that you have a target price. If the stock reaches your target price, first of all, you should be generally happy that the stock rallies substantially because that means you're going to make back, because you do have a return on your capital. You're just not making as much money, but what you're doing overall is adding a fair amount of yield to your portfolio. And that income has to come from somewhere. And what you're doing is you're giving away some upside, but only in this particular case, a very high amount of upside in exchange for a fair amount of income. Now, in this particular example, this is really where I see a lot of people panic. And this is, my best advice to you is that if you sold the cover call and the stock rallies substantially very quickly, don't do anything. Hold the position. And if you need to hold on or roll this cover call, meaning you think the stock can continue to rally from here, you only want to do something in the last week or two before expiration. So if, let's say you sold the cover call that's 60 days out and the stock rallies substantially in the next couple of weeks, don't do anything. Wait, because first of all, chances are the stock could decline a little bit over the next few weeks or so, and it actually ends up below your strike price, at which the call options expire worthless and you keep the premium and you can do it all over again. So don't do something early, because if you do something early, you're effectively locking in a loss for that short call. In the second scenario, if the stock moves sideways, this is your best case scenario because the premium that you collect is now yours. You can effectively let that call option expire worthless, or you can buy it back a little closer to expiration and roll it as you get, in that last week or so. And lastly, if the stock declines very sharply after you sold your cover call, that's really when you want to do something early, because you many times will have the opportunity to buy back the call option that you've sold for a small fraction of the price that you originally sold it for. And remember, when you sell a call option, you want the value of that call option to drop. So if it drops very quickly, take advantage of that by taking profits. And the rule of thumb here is that if you can buy back a cover call for 20% of the original premium that you paid for, that you collected. So if you collect $1 on a cover call and you can buy it back for 20 cents or less, then you do that. You buy it back for 20 cents, lock in that 80 cents of profit or income, and then sell a new cover call. And this will allow you to generate even further income or further yield faster than you originally anticipated. Yes, you're going to take a loss on the stock, and that's a decision that sometimes you have to make as to whether or not you still want to hold on to that stock, because sometimes you bought a stock because you think it's going to go higher, but if it keeps moving lower, in my opinion, it's best to cut your losses at some point. I know some investors don't like to do that. You don't like to take a loss. You will just hold on to a stock for years, waiting for it to get back to break even. I will say that while it might suck to take a loss, what sucks perhaps even more is missing out on new opportunities because you've tied up your capital in a losing stock. And you really have to think of it that way. And I think that's really what sets professionals away from many retail traders. I tend to see a lot of retail traders get stuck in this mentality that they don't want to take a loss. And what they do is they tie up lots of dead money in a stock that just didn't work out the way that expected to. And the reality is that not every stock that you buy has to go in the direction that you expect it to. You can't possibly be that every single stock that you buy goes in the direction that you expect it to. You have to understand that some stocks you're just wrong on. And it's better off for you to sell that stock at a loss and free up that capital for something that has a better opportunity, rather than staying in that stock for sometimes years waiting for that stock to get back to break even. If you can relate to that, just please type yes into the chat window. I'm curious as to how many of you have done something like that. And many times we don't think of it that way, but really you need to think about the opportunity cost of what keeping that cash locked in that underperforming stock is really doing for your portfolio. So hopefully that gives you a little bit extra in terms of food for thought in today's session. So when that stock drops substantially, sometimes I see people will continue to sell cover calls for years waiting for that stock to get back. But maybe you should rethink as to why you might want to reconsider that. So with that covers what I wanted to share with you here today. Everything that I've shown you, the OptionsPlay platform, the cover call report, this is all available to you at optionsplay.com/TMX. If you have not registered for an OptionsPlay account, you can do so for free, courtesy of the Montreal Exchange, at optionsplay.com/TMX, which I'll post the link here into the chat window. If you already have an account here at OptionsPlay, simply log in using this link here on your screen, and that will take you both to the platform, which is the platform right here, and you can use the cover call report that we send to you every single week. Every single Wednesday, we send you an email. So you should have gotten one earlier today with this report. But if you just bookmark this link, this report is updated every single day at about 10 a.m. So regardless of when you're looking to sell cover calls, you're going to be able to utilize this tool to help you quickly identify exactly which expiration date and strike price and how much premium you're actually going to collect and how much upside you have, right? So how far does the stock need to rally in that amount of time before expiration, before the stock is called away? And as you can see, for most volatile stocks, you have some pretty big upside in 30 to 60 days. So there's a lot of opportunities to potentially generate income across your entire portfolio. There are a lot of stocks that generate at least 1%. There's almost 200 stocks in here that generate at least 1% in about 30 days or so, a little over 30 days, and plenty of stocks that generate far more than that in 30 to 60 days. And I think a lot of investors are not quite familiar because you don't think of cover calls in yield terms. But when you think of them in yield terms, you realize how much yield there really is in many of these names. If anyone has a specific symbol of a stock that you own, feel free to type it out. We'll take a look at it real quick. I won't go through too many of them. I'll try to go through a few of them. So if you have a stock that you own, we can take a look at it. TD is certainly a popular one. Let's see if we can find TD here on this list. I know it's on this list. It might be lower on the list because it's not a very high or volatile stock. Let me see if I can find it for you guys. TD is right here. The August $84 call option will collect 0.75%, which annualizes the 7.63%. That gives you about 5.5% upside. Let's take a look at this particular trade. So this is the August $84 call option. This has a yield of 6.18% annualized, which comes out to be a little bit more than the 4.28% that you generate from the dividend itself. From my perspective, that's a respectable cover call to generate on TD, right? So this is the $84 call option. The stock is just under 80 bucks. The stock has to rally about $5 in the next 37 days before the stock is called away. What's another one? SAP. Let's take a look at SAP. We do have a search function, but I'm just trying to scroll through this real quick to see if I can find some of these names that you guys are looking for. Now, this doesn't have every single name because sometimes you just have options that are not very liquid but most names are in here. You have 300 plus names in this particular report. SAP's right here, generates 1.19% in 37 days. That annualizes to 12.42%, and that's the August $32 call option. So, you know, and look at how quickly I'm able to find opportunities, right? I just found 2 stocks in under a minute here. POW, I'm not familiar with POW. Let's take a look. You know, I'm doing this the hard way. I'm scrolling through it and I'm able to find the opportunities here within just a few seconds. And I know exactly what expiration date it is, what strike price to choose, how much yield you're getting. So all the information you need within a few seconds. POW, I haven't found POW yet. I'm not familiar with POW. So let me see if I can find it. Maybe I can't find it, and I'll show you how to do, oh, here we go, POW. 0.79% in the next 37 days. That annualizes out to 8%, a little over 8%. That gives you 4% upside. So I'm not familiar with POW, but let's check out POW here in OptionsPlay. Power Corp of Canada, obviously, probably utility, generates 5.88% annualized yields for a stock that pays about 5.6% dividend. So pretty much doubling your yield by selling the August $35 call option, which expires, you know, this is a stock that doesn't move a whole lot. So that's why the call options are relatively close to the current price. I'll do one more, BNS. That I know, Bank of Nova Scotia, which is probably a little bit on the lower end of this, of the report, because the banks, generally speaking, are not particularly volatile, not like the marijuana stocks. Sorry, my report seems to have frozen here. Give me 1 second. Bank of Nova Scotia, let's take a look. I know it's going to be a little further down. BNS, 0.69% in the next 37 days, 6.99% yield. The August $78 call options, which gives you another 5% upside. We'll take a look at this lastly, this trade one more time in OptionsPlay. What's wrong with my browser? Having some trouble entering this link. Let's try to copy and paste that instead. Sorry about that. Not working. Sorry about that. Not sure why that is the case. I will make sure that we get this fixed. It seems like this is my browser's issue. But regardless, what you're seeing is how fast I can go through a list of stocks. I just did 4 of them in the last few minutes. So if you have 10 stocks, you can do this in a matter of a few minutes here using using this report. And this report is published, like I said, every single day. We just sent you an email earlier today. If you have an OptionsPlay Canada subscription, which is free, courtesy of the Montreal Exchange. If you don't have one, you can sign up using this link here on your screen. You get access to both the platform and that report. So really, hopefully, this shows you a little bit about how you can use cover calls for your long-term investment portfolio. Some of the tips that I have regarding how do you use cover calls in a way that gives you or maximizes your income in the long run. And hopefully today showing you a little bit about how to implement and manage these trades very efficiently for your portfolio. So with that, what I'll do is I'll open this up for Q&A. I want to answer as many questions as I have time possible for the platform and the cover call report. So there's both a Q&A section and a chat window. If you type your questions in the Q&A window, I'll try to answer as many questions as I have time for here today. Is the 15 delta on Enbridge $60 call option 60 days an increase of $15 or 15 cents on a share of ENB? It would be 15 cents per share. If we're talking about per share, we're talking about 15 cents. Where do you find delta on your website? Great question. So when you're choosing your strike prices on OptionsPlay, let me bring up the platform. When you're choosing your strike prices on OptionsPlay, when you click on modify and you're choosing your strike prices, there are 3 numbers on your screen. You have your strike price, you have your premium, and then you have delta. So this last row tells you your delta. So puts have a minus delta, calls have a positive delta. That's how you can choose. So if you're looking for that 15 delta for POW, see that's between the 35 and 36 for the September expiration. So you have to make sure you select the right expiration as well. How do you find what price for the stock is 15 deltas? This is exactly what I was showing you here before, right? So if you go to modify, you select your expiration date. Let's say you choose August. You can then find your deltas. Whoops, these are puts. You can find your deltas by just using the strike price, right? So the 35s are 22 delta, the 36 are 10 deltas. So you would choose either the 35 or the 36 because those are the closest strike price to 15 deltas. But if the stock goes up and reaches the strike price, I could be exercised before expiration. In theory, yes, it's not common that that will be the case. It really depends on whether or not there's a dividend coming up and whether or not the extrinsic value of the option is trading below the dividend amount. If the extrinsic value of the option is trading below the dividend amount, yes, you are typically subject to potentially early assignment. You express deltas as a whole number, but delta in my Questrade express deltas as decimals. So you can just convert the decimal to the whole number, right? So the platform uses the decimals, right? But deltas is only between 0 to 1 or 0 to 100, however you want to think about it. Most people think of deltas as kind of because you multiply it by 100, that's why we use 15 deltas versus 0.15 because 0.15 or 0.15 is referencing per share. Versus for every contract, you're actually multiplying it by 100. And that's why it's the 15 delta and 0.15 are used interchangeably. How do you decide between a put or call option in a bearish situation? Not sure I understand the question, Nick. If the question is, how do you decide whether you buy a put or sell a call? That really depends on kind of your directional view. If you're expecting something to move substantially lower, you're always better off buying a put option. If you think something is going to not go much higher, meaning you think it could move lower, but it could also just stay where it is, you're better off selling that call option. So it's really more based on your outlook, more so than anything else. Is this recorded? And do you have also cash secured put? Yes, this session is recorded. And the report actually has a short put report as well. So we do the exact same thing for stocks that you want to acquire. Now, I didn't have quite enough time to discuss that as a whole strategy today, but the report gives you both the cover call and cash secured put. So if these are stocks that you want to acquire and you want to sell a put option, you can do so as well using our report. Where can we see implied volatility? So implied volatility is here in this particular corner, this particular column. You can also see it on our platform. So if you're looking for the implied volatility of an option, you can look at the current implied volatility, for example, on POW is 17.33%. It is down here on your platform. Are there best practices for choosing an underlying stock from the cover call report? So the cover call report is only there to help you understand how much yield there's available to collect on a given stock. The report is not designed to help tell you what stocks to invest in. And the reason that is the case is because all of us as investors seek different things. Some of us are more risk adverse, some of us are more risk tolerant. And some of us buy stocks based on technical reasons, some based on news, some based on fundamentals. Everyone has their own kind of thought process and theory as to how they go about investing in an underlying stock. So our report is agnostic as to how you choose to invest. For me personally, I typically need to have a strong fundamental view on the underlying stock from a valuations perspective, typically, as well as just an understanding of the business from a competition as to how they are in competition relative to their peers. And then lastly, from a timing perspective, I use the charts, technical analysis to help me increase the risk to reward ratio as far in my favor as possible. So if I'm buying, I wait for pullbacks to buy. If I'm selling, I wait for rallies to sell into them. So that's more of a timing aspect, and then using the fundamentals from a valuation and understanding their business to make a case for the investment, if you will, long term. Volume of options trading is low. How do you reduce the time per trade? I'm not sure I understand that question. What does volume have to do with time? I'm not sure I understand that question. If you don't mind rephrasing that question, can you please go over the rolling down, buying back at 20%? Why wouldn't you let it expire? So great question. So let's take a look at an example. Let's go back to Shopify, for example. Whoops. Let's say I'm looking to sell the August. We were looking at the August 41. I think we were looking at something like maybe the $50 strike price on that. And I'm collecting $1.75, right, for this $50 call option. So what's 175 times 0.20? So if something you sold for $175 is now trading at $35, sure, you can let time work, continue to work and make the other 35 cents back. But the amount of premium that you're going to collect for each day between now and expiration is so low. And if the stock was to rally substantially, you're going to now lose a good chunk of that profit that you've made. So why do that? You can lock in the vast majority of the profits and sell a new cover call and start generating or start collecting premium at the same pace that you were before. So it's really just about how much premium do you have left to collect, how much time is left, and what is the premium that you're collecting per day, and taking into account the risk that you're taking to collect that small amount of premium each day. It's not worth it. You're better off buying back the call option, selling a new cover call, and simply generating income at a faster rate again. Hopefully that answered your question. If you are sold out of a stock that you consider a long-term position in your portfolio, how do you determine the price to sell a put option to reacquire your long-term position? Great question. When you're selling puts, generally speaking, you're selecting strike prices that are pretty close to the current price. Look at the distance to strike column for short puts. Notice that most of them are just a few percentage points away. We've done the back testing on short puts as well. We tend to find that puts that are relatively close to the current price will perform better for you in the long run. You're going to get a bigger discount on the stock purchase, and you're going to be able to have a higher probability of owning that stock. I did cover when to exit, so if you missed that, please watch the recording. I did do a whole slide just on that alone. Do delta implied volatility change moment to moment, or they remain same for a period? So, they don't change drastically intraday. If the stock moves drastically intraday, you can see them move quite a bit. But for the most part, from an hour or two, you're not going to see drastic changes in that stuff. When writing a call or put in this volatile market, is it best to have it expire less than 4 weeks? So expiration, you're going to collect more premium in more volatile times. Doesn't matter whether you go 4 weeks out or 4 months out, you're just generally going to collect more premium. The reason that we generally don't do short dated options is because you're going to collect less premium. And each earning cycle, you have that obligation. So what happens is that you could end up collecting very small amount of premium if you do a short dated option and you're out of the stock, right? So you never really had any real income to show for. So for those reasons, and also if you consider the higher transaction costs in Canada, that's really why we typically go a little further out than 4 weeks for selling cover calls. We will send out the recording to you by tomorrow morning. What do you think of a strategy of selling cover calls and also selling a put well out of the money on lower volatility stock? Gordon, this is what we call a covered combo strategy. It's a strategy that is quite commonly used by a lot of financial advisors where the client has plenty of cash and is willing to acquire more shares at a lower price, and you're just boosting the yield, but you have the obligation of buying more stock. It is a very common strategy. in my opinion, amongst more institutional type players, especially it's players that say, you know, I own the stock, I'm willing to buy some more if the stock declines, you know, substantially lower. So absolutely, Gordon, it is a strategy that is quite commonly used by more of the institutional players. How often is data on the platform updated? It is streaming, so every time you type in a new symbol, we're pulling in that live data for that specific symbol. Any other questions for today? If there are no other questions, I just want to thank everyone for taking the time out here this afternoon. I really hope that this was helpful in giving you a better understanding of the platform, the cover call and short put reports, if you are using these strategies. And hopefully, if you have never used one of these strategies, this inspires you to take a look at adding some yield to your portfolio in this type of volatile environment, because the more volatility there is, the more yield that you can also collect on these types of strategies. And many times in these types of market environments, that's when you need that yield. That's when you need the downside protection. So hopefully this shows you how you can go about doing that. And if you have any questions, feel free to contact our support team by clicking on the questions ask us button here in the upper right hand corner if you have any questions regarding these reports or using these tools. With that, thank you so much. I hope you have a great trading day, and we'll send out the recording to you as soon as we have finished processing this for today. Thank you so much and have a great evening.